Gold, IRAs, and inflation, the coming disaster for equities. First, I'm an investor, not an advisor. My opinions are my own, and Financial Freedom is a professional review YouTube channel. I may receive compensation from the companies whose products I review and recommend. However, Financial Freedom is independently owned by me, and the opinions expressed here are mine alone. Although I do my best to be objective, my recommendations may not be neutral or independent. So be sure to investigate, ask questions, and seek professional advice on any investment decision you are contemplating. In a moment, I'm going to show you how the Fed has done a 180-degree shift in its policies from the 1930s, and this is dire. But first, disaster is looming for equities and the stock market. People generally buy bonds for economic safety, and Economics 101 teaches us that bond price and yields, the interest that the bonds pay, are inversely proportional. So, as investors buy bonds, forcing prices up, yields go down. And aggressive bond buying will lead to a persistent decline in yields. Well, here's what's going on right now. The 10-year Treasury bond closed just the other day with a yield of 0.536%, marking its second lowest daily close of all time. A near record low yield on the 10-year Treasury bond indicates an exceptional amount of distrust in equities and the stock market. To investors, real money losses to inflation are more palatable than investing in stocks. That is a real warning sign. The smart money is out of the market altogether and willing to take a hit on inflation rather than try to have growth in their equity portfolios. Here's another warning sign. Labor underutilization. Labor underutilization is a measure of folks who are out of work plus those forced into part-time employment or employment that's well below their skill set. During the pandemic, labor underutilization initially spiked to 22.8% and remains at 18%. What this means is that nearly a fifth of the civilian labor force in the U.S. are either unemployed, stuck in a position where their skills aren't being used properly, or have been forced into part-time work. This is a much more meaningful statistic than pure unemployment, because we could have high unemployment, but if people are being underutilized in the labor force, the economy is suffering. Another warning sign that's flashing are auto loan delinquencies. Basically, car owners aren't paying their bills on time, if at all. Repossessions are way up, delinquencies are way up, and this has a dire consequence for the regional banks, credit unions, and other financial institutions that make a lot of money loaning people money to buy cars. And if they aren't paid, then their liquidity goes down and the economy takes an even further huge hit. Earlier I said we would cover the Fed's dire reaction to all of this, and I use that word dire a lot these days because it is dire. Since its creation, the Fed has been charged with monetary policy that maintains full employment and keeps inflation manageable. Makes sense? But not anymore. Recent statements from Fed officials point to a move to average inflation, targeting inflation above 2%. In other words, the Fed is now interested in creating inflation in the economy. Fed Regional President Charles Evans of Chicago said he would like to keep interest rates where they are until inflation gets up to around 2.5%. And of course, with interest rates at 1% or less, the Fed can do nothing to foster full employment. So the Fed's mandate has flipped. Build inflation, forget about full employment. Well, the investment implications on this are substantial. The markets have been betting on higher inflation with surging gold prices, a falling dollar, and a rush to inflation-indexed bonds. The only reason the stock market is doing what it's doing today is because of a lot of unsophisticated part-time investors who have a fear of missing out under the top of the bubble. They're going to lose their ass. The smart money is completely out of the market. Well, the Fed's approach will be wildly bullish for growth stocks and gold and silver for a few years ahead. We can see this. Gold prices are on the rise, approaching $2,000. Some analysts predict gold to reach as high as $3,000 per troy ounce. So this is a really good time if you are considering diversifying part of your IRA account into gold to check out Regal Assets. Click on the link to get your free gold investment kit. If this was useful and informative, click on the link below, like this video, and subscribe to the channel. And also click on the link to sign up for my free 10-part training on how to invest in gold. And get your free gold investor kit from Regal Assets. So, be sure to like the video, comment on it if you like, subscribe to the channel, and get your free gold investors kit here.